If you follow some of the financial forums, financial blogs, or read investing books, you'll often hear of some stocks referred to as the best stocks, high return low risk stocks, the aristocrats, single best investment stocks, the thoroughbreds, blue chip stocks, and rock solid stocks. You may even know that those phrases are used to describe a group of stocks which have a long history of being the most reliable stocks in the Canadian or United States stock markets. They are the companies which have consistent earnings, steady growth, and those which have usually been success over a long period of time. They are not normally the high-growth stocks, but you will find that many of them make up the top 10 stocks of most mutual funds and ETFs. If you compile a list of them, you might find there are 30 to 40 Canadian and United States companies which always seem to appear on everyone's list. In fact, the stocks that make up those lists don't change too often. You'll also hear comments like, "Everyone knows these best stocks," or that the price already takes into consideration these best stocks. Yet, when it comes down to recommending how you should invest your money, the word diversification is the first criteria to be met. Some investors will say they own several of those best stocks and don't plan to sell them, but they only make up a small portion of their portfolio. Today, the majority of financial advisors will recommend a basket of ETFs. These ETFs will include those best stocks, but they'll also include a variety of the other stocks, those which would not be considered quality companies, those which might offer greater growth, those which are cyclical stocks, those foreign stocks which might not offer regulatory controls, fixed asset investments, and those which might be considered high risk. So, when you buy an ETF, you'll own some of those best, rock-solid stocks, but they'll only represent a portion of your holdings, maybe 40%, possibly more, but they'll be diluted by all the other holdings. It has to be so. The reason for this is that ETFs seek to mirror the market or index, and market returns as their objective. I take a different approach to investing. I like those best, rock-solid stocks. They are easy to identify, they are easy to analyze, they are less risky than other stocks, and if you are investing for income, the best of them provide a predictable income. I don't need to include stocks not considered the best, stocks which don't pay me an income, and stocks which are riskier. I want to own just the best stocks, the ones that have paid and increased the income they pay me, and the ones I feel will continue to do so. But, who says you can't diversify by sticking with just those stalwarts, or what I call quality stocks? If you take the time to compile a list of the companies which you consider the best, I think you'll find that they are not concentrated in just one or two sectors. They will be spread across various sectors and markets. I would rather stick with just those quality stocks, the ones which everyone agrees that they are the best stocks to own, those which have a long history to back up their status, and those which have been around for a long time, proving that they have remained the best companies through thick and thin, good times and bad. So, diversify, but only diversify amongst the best stocks. If you found this YouTube video of interest, please visit our blog and read more about investing for income. And no, we are not seeking subscription fees or asking you to sign up for a newsletter, just me expressing opinions.